Good afternoon, and welcome to the 800 Credit Score Man Show. I am your host, Kevin King. He is I, and I am him, the 800 Credit Score Man himself. And I want to thank each and every one of you guys for tuning in to the 800 Credit Score Man Show, no matter how you get it. If you're listening to me on Spreaker.com, I will ask that you go ahead and follow me there. Please follow me there. You should get updates. Every time a show comes on the air, you should get an alert that says, hey, it's on the air, and we can go ahead and maybe we can talk via Spreaker.com. But of course, you can catch it on Stitcher, you can catch it on iTunes, you can catch it on Google Play, and of course, we have the 800 Credit Score Man Show app. So get the app. Everybody go ahead, download that app. It's free. Get the app and listen to the 800 Credit Score Man Show there. You can get all of the episodes at any of those places. And of course, it's also actually on YouTube. So I had a few people that actually follow me on YouTube. They leave comments there. You can do those things there as well. So get the 800 Credit Score Man Show. There are no excuses at all for you not to have and be able to listen to the 800 Credit Score Man Show. All right. So thanks again for coming in. What in the world are we going to talk about today? Today, we're going to talk a little bit. I told you guys we're moving from a little bit from this mission to a movement in itself. Mission has always been to help you increase your credit scores. That's going to lower the interest rates that you pay, and it's going to save you money, keep money in your pocket. And so what we're doing as far as the movement is concerned, we're expanding. So we're expanding for me to come out and speak to individuals, speak to groups as well. But then also we're going to incorporate some information about finances that are other than just your credit to help you improve overall. And then, of course, when we talk about increasing your credit scores and lowering those interest rates, oftentimes we're talking about if you're going to buy a mortgage, if you're going to get a vehicle, something like that. Well, today we're going to explore a little bit about what do lenders look for? What are lenders looking for when they look at your credit report, when they look at your application? And specifically, we're going to talk a little bit more around mortgages. That seems to be the biggest thing that you would ever purchase in your life. For a lot of people out there buying homes, this basically is the buying season, basically from March when it, or April when it kind of turns nice through the fall. People are always trying to get into a home prior to their kids having to go to school. So they want to get into that district and be able to register their kids for school. So this definitely is the buying season. So today we're going to talk about what do lenders look for when they're looking at your application and your credit. And of course, within all of that, there are going to be some information that'll help you improve your credit scores as well. So before I jump right into that, let me give my first shout out. So if you're new to the show, welcome to the 800 Credit Score Man Show. And during the show, we present that topic. We talk about the topic. Then, of course, we have the question of the day, which comes from you, the listeners. Please send me your questions, 800 Credit Score Man at gmail.com. Send me your questions. I will answer it directly, and then you may become a part of the 800 Credit Score Man Show family if I use your question on the show itself. So that's how it pretty much works, and I give shout-outs throughout the show. So if you have anniversaries or birthdays, whatever it is, let me know, and you may be shouted out on the 800 Credit Score Man Show. So my first shout-out today, I want to give a shout-out to Archie Gibson. Archie Gibson celebrated a birthday earlier this week, so I want to say happy birthday to him. I also want to give a shout-out to Laura Whitaker as well. So Laura Whitaker celebrated a birthday earlier this week as well, so happy birthday to you. So let's jump into what do lenders look for when they're looking at your application. So when you call a lender, and no matter if it's the bank you call or if you call a mortgage place, or even if you fill out something online. If you fill out something online, you try to go through like a place like Lending Tree where they take your information, they send it out to a bunch of different people that may lend you money to buy this particular home. Then what in the world are they looking at? So first thing that they look at, of course, is your credit score. That's the first thing that they're going to look at. Now, it's not the only determining factor if you're going to be approved or not. So you can have an 800 credit score and be denied for a particular loan. I believe, or I don't believe that, with my credit score, that if I went and applied for a 200 or a $2 million home, that they would go ahead and approve me for that, because there are other factors within that as well. Even though I have a good credit score, you've got to be able to pay it back, things like that. So what are the criteria? What are they looking at? So the first thing, of course, they're going to look at that credit score. So if you got a decent credit score, or at least you qualify one way or the other, at this particular point in time, you can qualify for a mortgage even at a 580. So a lot of places will go ahead and they will approve you at a 580. It's a particular kind of application or mortgage that you'll be available for. And of course, at a 580, when your credit score runs from 300 to 850, at a 580, you're in the lower range. Your interest rates are absolutely going to be a little bit higher in that regard. At some places, they cut off at 640, or some particular programs, they cut off at 640. Sometimes if you have a 720, maybe 740 or 760, you may not have to pay PMI. That's private mortgage insurance. If you're in a state where you have to pay PMI, and that's basically you're paying insurance for the lender in case you default on the loan. So the lender will get paid if you go ahead and default on the loan. They'll get paid anyway if you are paying PMI in your mortgage, and it's a monthly account, so it'll go into what your payment is as well if you have to pay PMI. Typically, you pay PMI if you do not put down 20% of whatever the home costs when you close on that mortgage. There are a lot of programs out there, especially if you're a veteran. You may not have to put anything down. Maybe just put 1% down, 3.5% down, or 5% down. But if you don't put 20% down, typically you may have PMI. And not all states require that you have PMI, but several do. So that's something that you would have to look out for as well when you're trying to calculate how much your payment is going to be. What's going to be my PMI? Because that's going to go on to whatever your mortgage payment is. All right, so not only are they looking at your credit score, okay, so figure out where you fit in that. When they look at your credit report, they're going to pull your credit report, right? They're looking to see if you pay on time and how recent those things are. So if you do have, say, a 600 credit score, if you got a 600 credit score, that means it's on the lower rung. But let's say you've been on time with all of your payments over the last year and a half. You just haven't done anything that has moved your credit score up. Or maybe you started at a 480 and now you're at 600. So you're at 600, you may be able to be approved for a particular loan, but they're looking to see what your recent history is, how well you have done. So you cannot have late payments in the very recent past. You cannot have late payments if you're going to go ahead and be applying for a mortgage. So they're looking to see if you are paying on time. If you listen to the 800 Credit Score Man show, that's one of the criteria that makes up your credit score is how well you pay. It's actually the biggest criteria. So 35% of your score in itself deals with how well you pay your bills. So they're looking at that. Then they're going to take a look at, and they're going to look at your total balances on everything. But they're going to look at your total balances specifically if you have any credit cards. So if you have credit cards, they're going to see what balances you have, and they're going to compare those to whatever your limits are. So they want to see if you've maxed out those cards. If they're very, very close to the limit, that's not going to be good for you, especially if you're on the lower rung, you're barely getting approved. They're going to want to see some space in between how much you owe and whatever that particular limit is. They're going to be looking at that. They're also going to be looking at them, overall, all together, but they're also going to look at those cards individually as well. So it's not good for you to go ahead and max out one card, but you have 3 other cards that, basically you have no balance on or very low balance. That's not going to be necessarily good for you. So if you could, then if it was spread out, it would actually be a little bit better for you, as long as you stay under 30% for your credit score's sake. If you stay under 30% on all those cards for your credit score's sake, then your score is going to be a little bit higher. So those are some of the things that they'll be looking for on your actual application when they pull your credit report. They'll be looking at those things. And what I just talked about with the balances versus your total limits, that's basically 30% of what makes up your credit score. So if you can handle that part and you can get it down to under 30%, your score is going to rise as well. So maybe you do have that 600, but you have a 55%. That's called your debt utilization. If you have a 55% debt utilization, you're above the threshold that gets you the most points, if you will, for your credit score. They're also going to be looking at, like I said before, your recent history. Have you added anything? Have you added any new accounts lately at all? How well are you dealing with those particular accounts? They're looking at all of those things. If you're going to apply for a mortgage, I suggest you not get anything new within 6 months of you applying for that mortgage. That means don't go out and buy a car. Don't go finance a new refrigerator. Don't go do any of those things if you're going to be applying for a mortgage, at least bare minimum 6 months. 9 months would be better, but bare minimum 6 months. Don't go and get new accounts and new creditors placed onto your credit report. That also means with credit cards. You've got to be very careful when your credit card company offers you another card. So you may have a card with a place like Citibank or with Chase, and they're offering you another card. Be very careful in accepting those things if you're going to be applying for a mortgage anytime soon. So they're watching for those new accounts. They're watching your recent history as well. And then, of course, they're going to look at how long have you had credit. So they're trying to gauge if this person's had credit for a long time, then in their mind, they can tell how well or how bad you're going to go ahead and follow through and pay your bills. So they're looking at how long you've had credit. So sometimes if it's a person with a newer credit file, let's say you could be 30 years old and never really use credit at all, and your credit file is newer, then that may come back to haunt you a little bit, only if some of the other criteria are a little sketchy. So it's not always the case, but if the other criteria are a little sketchy, then they're going to be looking at that as well. So that basically takes care of the credit report and the credit score portion. I will mention right here, if you do file or you have filed bankruptcy, there is a limit or a time frame that you can't go ahead and get another mortgage. Most of the times it's 2 years. You've got to wait 2 years if you filed a bankruptcy to apply for a mortgage and actually obtain one. It might be up to 4 years in some cases as well before you can go ahead and apply for a mortgage and obtain a mortgage if you file bankruptcy. Now, that doesn't mean, because I've talked about this on the show before, it doesn't mean that you don't have to help your credit. Doesn't mean you can't help your credit and apply for other things after you file bankruptcy. 6 months, 9 months, 10 months after you file bankruptcy, you do need to apply for other credit so you can start reestablishing. But far as someone approving you for a mortgage, you got to wait 2 years at least. And in some cases, it's going to be 4 years. So I wanted to put that pin in there for you guys as well. Now, what else are lenders looking for besides your credit score and your credit report? They're also looking for your employment history. So they want to see a good employment history. They're looking for stability, if you will. So if you've jumped job to job, every 6 months over the last 4 or 5 years, that's going to be an issue for them. They're not seeing the stability. Even if you've paid your bills on time, your credit score is good and all of those things, that may be something that knocks you out of the running for being approved for a particular mortgage. Now, if you stay within the same industry, oftentimes they'll go ahead and give you credit for it. But if you switch industries, you used to be a social worker and then you went to be a teacher, you used to be a teacher and now you're a police officer, those kinds of jumps from industry to industry are a negative indicator for mortgage lenders. So they're looking at that kind of stability. So if you can at all, avoid making that move with your employment as well when you're about to go ahead and apply for a mortgage to get a home. Make sure you do that. So they're looking for that. So I already mentioned the BK filing on here as well. So another option that they're looking for, period that they're looking for is your debt to income ratio. Not to be confused with your debt utilization, but your debt to income ratio. So that's how much money you actually make, and then how much debt do you have. So how much you have income incoming and then also how much you have outgoing. They're looking for that as well. And I'm going to explain that a little more